Welcome back to the deep dive. This session is, well, I'd argue it's the most essential one in your entire NESM Series 12 preparation.
I have to agree.
We've covered the market structure, the how of trading in Chapter 1. Now we're getting into the instruments themselves, the actual menu of investments you need to know cold.
This is absolutely where the rubber meets the road.
So today we're tackling Chapter 2, securities, features, and that foundational concept, asset allocation.
That's right. And our mission today is very, very clear. We need to get you past just memorizing definitions. We have to really master the mechanics of these instruments.
You need to understand the legal character, right? The difference between owning and lending.
Exactly. And then, most critically, we have to unlock the math. The valuation and risk management for both equity and debt. Every single key definition, every ratio, every single numerical threshold. It has to be crystal clear for your exam.
Okay, let's lay the foundation right now. When anyone, a company, a government needs money, they issue a security. But every single investment decision you make flows from one sort of binary choice. Is this instrument equity or is it debt?
That is the foundation.
Yeah.
If you miss this initial distinction, the rest of this material is just unnecessarily complicated. So equity capital represents ownership.
You become a partner.
You're a partial owner of the business, yes. And debt capital, that represents lending. When you buy it, you're a creditor. You're a lender to the business. And the legal and financial implications of this divide, they're just enormous.
Let's systematically define these then, starting with the riskier asset. Equity capital. The first big feature to highlight has to be its availability for perpetuity.
Precisely. Equity capital, once it's raised, it doesn't come with an expiration date. There's no fixed repayment obligation. It stays with the company for as long as the company exists.
And because there's no fixed repayment date, there's also no fixed return.
No fixed return, no assurance of a payout. Equity holders are taking on the non-fixed risk of the business itself.
And because they are owners, they get to participate in the governance of the company, usually through voting rights at the annual general meeting.
Correct. And that really helps us understand why this is the riskier long-term asset class. Its performance is completely dynamic. It's directly tied to the success or, the failure of the business.
It's the high volatility growth part of your portfolio.
Exactly.
Okay, now the concept that truly defines equity for the exam is residual benefit. Could you unpack what that residual position means for the equity holder, especially when it comes to profit?
This is critical. So let's imagine a business needs, say, 100 million rupees for an expansion. It borrows that amount from debt investors at, let's say, a 9-terminate fixed interest rate.
Okay.
Now, if the business successfully uses that capital and earns maybe a 15% return on it, the debt investor gets their promised 12%. That's it. No more, no less.
They get their slice.
They get their slice. That extra 3% return, that is the residual benefit. And it flows entirely to the equity shareholders.
So the equity holder is basically leveraging the debt holder's stable capital to generate these outsized returns for themselves.
Exactly. They get all the disproportionate upside after all the fixed costs, including borrowing, are met. But, and this is the important part, there's a flip side. This is why we call it risk capital.
Right.
If that business only earns 10% on the borrowed capital, well, the debt investor still demands their 12% interest.
It's a non-negotiable contract.
It is. That deficit, that loss, is borne entirely by the equity holders. They might earn nothing, or even worse, they can see their principal value just get eroded. The equity holder is always, always last in line.
Okay, let's flip it then. Let's go to debt capital, or lending, the fixed income side of the equation.
So debt is characterized by 3 main structural features, which we'll get into, but the most foundational one is maturity.
A hard deadline.
A hard deadline. The capital must be returned to you, the investor, after a specified, contractually fixed time. And in the meantime, you receive a coupon, which is a pre-specified fixed rate of interest, and of course, the timely return of your principal.
And since they're lenders, not owners, they don't get involved in the day-to-day management of the business.
No, they don't. And this is what makes debt a relatively lower risk, steady, and income-oriented investment. It's designed to generate a predictable stream of income, provided, of course, the borrower meets their obligation.
So the investor's choice is that classic trade-off. Do you want lower risk and a lower stable income, which is debt, or do you want potentially higher returns balanced against that extra volatility and risk, which is equity?
That trade-off is the very essence of asset allocation. That's the process where you, the investor, systematically distribute your investable surplus between equity and debt or other asset classes. It's all based on your return goals, your time horizon, and your personal appetite for risk. It's really the first practical step in managing a portfolio.
We've covered the investor side. Now let's pivot to the issuer. Why would a company choose one type of capital over the other?
Well, issuers have two broad categories of capital needs. You have working capital, that's short-term money for daily operations, like paying for inventory or receivables,
The day-to-day stuff.
the day-to-day. And then you have long-term capital, which is for big investments, physical plants, machinery, infrastructure.
hmm
The short-term needs, they're almost always met by short-term debt. The real strategic choice between equity and long-term debt happens when you're financing those major projects.
And a crucial exam note here, governments, both central and state, usually issue only debt capital.
Yes, in the form of bonds or bills. They don't issue equity ownership stakes in the country.
So for corporations, it's a strategic balancing act. You've mentioned 4 critical factors here. Let's break them down.
Let's do it. Factor 1 is the ability to pay periodic interest. Interest payments on debt are a legal, non-negotiable obligation. If a business, say a utility company, generates really stable and predictable profits, they can comfortably commit to servicing debt. In fact, debt capital is great for them because interest is tax deductible.
But a startup,
A growth stage tech company with volatile or even negative profits in the early years, they're going to struggle with that commitment. They would much prefer equity, where paying dividends is discretionary, it's flexible, and it's tied only to the available profit after tax.
makes sense. Factor 2, willingness to dilute ownership. This is all about control.
Exactly. When you issue fresh equity, you're sharing the pie. You're diluting the existing promoter's stake in their future share of the profits. If the existing owners want to maintain control, let's say they want to keep a 51% majority voting stake, they will strongly favor debt financing, even if it comes with a heavy interest burden.
All right. Factor 3, ability to give collateral as security.
Lenders, by their nature, prefer secured borrowings. If a business is asset-heavy, think of a manufacturing plant, a shipping company, or a real estate developer. They have plenty of tangible assets they can pledge as collateral.
Which makes getting debt easier and cheaper.
Much easier. But a service-based company, like a software firm that relies on intangible assets like code or patents, they often find it really difficult to offer adequate collateral. That makes equity financing their primary, and sometimes their only, option.
And the final factor, number 4, the time period for which capital is required.
Short-term needs are almost always debt, since you can repay it quickly. But the longer the time frame, the harder it is to secure debt because lenders get, well, they get risk-averse over very long horizons.
20, 30 years is a long time.
It is. So if the need is truly long-term, say for a massive infrastructure project with an uncertain 20-year timeline, and if debt investors are just unwilling to take on that extended duration risk, the firm will likely be forced to issue equity. They're essentially sharing that long-term project risk with new owners indefinitely.
Okay, with those fundamentals locked in, let's dive deeper into equity itself, starting with its core features. We said equity is risk capital, provided by owners who accept non-fixed risk.
Yes, and we should detail the physical form. Equity capital is issued in shares, and each share has a face value or par value. Now, this is purely an accounting number. In India, it's typically very small. 1 rupee, 2 rupees, 5 or 10.
It's crucial to distinguish this from the market price.
Absolutely. The market price could be thousands of rupees, reflecting the actual value of that residual claim.
Now let's look at the ownership structure. We usually classify shareholders into inside shareholders, the original promoters, the founders, maybe early-stage VCs, and outside shareholders, which is the general public who buys shares in an IPO or on the stock market.
And this ownership translates directly into a stake. If a promoter holds 1,100 shares out of a total of 10,000, they hold a 51% majority stake. That gives them effective control.
We should also touch on employee stock option programs, or ESOPs.
Oh, definitely. These are fantastic incentive tools that allow employees to acquire a small stake in the company at a preferential price. It effectively turns them into internal stakeholders and aligns their performance directly with the company's success.
Okay, let's go back to returns and claims, because that's what defines the risks. The return is a variable return.
Meaning the periodic dividend is entirely non-fixed, it's not assured, and depends solely on the company's profitability and the available surplus after all the costs, interest, and taxes have been paid.
Which brings us right back to the residual claim. You have to memorize this for the exam.
You do. Equity shareholders are ranked last, dead last. for both profit sharing and, critically, for liquidation proceeds. Think of it like a waterfall.
Okay.
When a company shuts down, the money it has from selling its assets first pays the government for taxes, then it pays the lenders their debt back, then it pays employees their salaries, then preference shareholders. Only if there is anything left over, the residual, does it finally go to the ordinary equity shareholders.
That's why the risk is so high. If the business fails spectacularly, there might be absolutely nothing left after the lenders are paid.
Precisely. It's the ultimate risk, but it also comes with the ultimate potential reward if that residual benefit is large.
This concept is also tied to internal growth. If a company makes a profit but decides not to pay a dividend, those undistributed earnings are called retained profits.
Yes, and those retained profits, along with some other allocations, become the company's reserves.
And the crucial connection is this. Capital plus reserves equals the company's net worth.
Right. So retained profits enhance the net worth, which fundamentally increases the underlying value of the equity shares, even if no dividend was actually paid out in cash.
Right.
This is a very common strategy for fast-growing companies. They retain, they reinvest, and they grow the share value instead of paying dividends.
Let's talk about management and control, especially for big public companies. We often see a separation of ownership and management.
Yes. While the promoters might own the stock, professional managers are often hired to run the daily business, and those managers report to the board of directors, which is elected by the shareholders,
The board also includes independent directors.
who are specifically mandated to represent the interests of the common, outside shareholders, ensuring there's a balance of power.
And the fundamental democratic right here is that each share has a vote.
That's right. Whether you're electing the board or approving a major merger, shareholder approval is expressed through that voting mechanism.
Now, equity isn't just one single thing. There are two major variations that blend risk and return differently. First, let's talk about equity shares with differential voting rights, or DVRs.
DVRs are they're structural tools. They're used mostly by promoters. They allow the company to issue shares that purposefully separate the financial benefit from the voting rights.
So what does that mean for an investor?
An investor buying a DVR share typically gets a higher dividend rate, maybe 5 or 10% higher than an ordinary share. But in exchange, they have to accept proportionally lower voting rights. For example, one DVR share might only count as, say, 1/10 of a vote.
So why would a promoter issue these?
It's purely a control mechanism. It lets the promoter raise significant necessary risk capital from the market without really diluting their ownership stake and, crucially, without losing voting control over their company. It's a very effective way to raise funds while keeping the balance of power.
The second major type is preference shares. These are a true hybrid. They pay a predefined rate of dividend, which gives them a debt-like feel.
They absolutely feel like debt, but for the exam, you must be precise on the distinctions. They are fundamentally equity. Let's look at 3 areas where they differ from debt, like a debenture.
Okay, distinction 1, investor status.
A preference shareholder is a shareholder, an owner. A debenture holder is a creditor, a lender. That's a core legal distinction.
Distinction 2, security.
Preference shares are not secured against the company's assets because they're not legally a borrowing. Debentures, especially corporate ones, are very often secured.
And distinction 3, the critical tax difference. This really reflects their risk profile.
Right. Interest paid on a debenture is treated as a business expense. It's paid before corporate tax is calculated. But dividends on preference shares, they're paid out of the residual profit after all external liabilities, including corporate tax, have been settled.
So that makes them riskier than debt, but safer than ordinary equity.
Exactly. They have preference over ordinary equity in 2 areas, in dividend payments and in the return of capital if the company is wound up.
They get to jump ahead of the ordinary equity holders in that liquidation waterfall we talked about.
They do. However, because their dividend is fixed, they have almost no scope for capital appreciation. Their value doesn't explode if the company does amazingly well, and they typically lack voting rights.
And there's a key protection mechanism we need to define: cumulative preference shares.
Right. If the company can't pay the predefined dividend in a given year because profits are low for cumulative shares, that unpaid dividend is carried forward. It has to be paid in subsequent years when profits recover before any dividend can be paid to ordinary shareholders.
That significantly reduces the income risk for the investor.
It does.
Let's just confirm the returns picture for equities. Returns come from 2 sources: cash flow via dividends, and the potential increase in value on the secondary market, which is capital appreciation.
And both of those are entirely dependent on future cash flows and profitability.
So the fundamental risk is that those future benefits are simply not assured or guaranteed.
They're not. They have to be estimated. Equity returns are highly volatile because they mirror the constant flow of new information, economic, business, political, into the stock price. Prices are moving constantly as people anticipate success or failure.
Okay, now that we've detailed both asset classes, let's revisit the 4 criteria that should determine an investor's allocation. Let's bring this back to portfolio construction.
Right. Criterion 1. Need for regular income versus growth.
Debt is fundamentally income-oriented. It's the perfect asset for investors like retirees who need predictable, steady cash flows.
Whereas equity is the growth engine.
Yeah.
It's for people seeking long-term capital appreciation, who are willing to accept little or no dividend income now for greater value down the road.
Criterion 2, time horizon. This is a huge determinant of risk suitability.
It is. Most corporate debt in India is short to medium term, say 90 days to 7 years. So investors with short-term needs should choose debt. Equity, on the other hand, is best for investors with a long-term orientation. Think 10 years or more.
Because while equity is volatile in the short term, that volatility tends to smooth out over longer periods.
Maximizing the benefit of compounding growth. Investing in equity for just a couple of years is significantly riskier.
Criterion 3, risk appetite.
Debt instruments are structured to return your principal. They're stable, though they do carry default risk. But equity, it demands a substantially higher appetite for risk. Not only is the dividend uncertain, there's no assurance of principal return. If the business fails, your invested capital could be completely lost.
And criterion 4, frequency of review.
Active investors, the ones who monitor the market daily and are willing to sell underperforming assets, they prefer equity because it's highly liquid, it's listed and traded continuously.
Whereas debt investors are often more passive.
They often adopt a simple buy and hold to maturity approach. They're relying on that fixed contractual obligation, which requires far less frequent review.
Okay, time to shift our focus entirely to debt. Debt capital is the reliable anchor of a portfolio, provided by lenders expecting regular fixed interest and timely repayment.
And we have to nail the 3 foundational features of any debt security contract. These 3 terms define every bond, every debenture, every bill.
Feature 1, principal or face value.
This is the actual amount borrowed. It's the contractual obligation due on each security. If a bond has a face value of 100 rupees, that's the principal the borrower has to eventually repay you.
Feature 2,
coupon. The coupon is the pre-specified fixed rate of interest. It's always expressed as a percentage of the face value.
Yeah.
And critically, the periodicity, whether it's paid quarterly, semi-annually, or annually, is legally defined in the contract.
And feature 3, maturity.
The hard deadline. It's the specified date on which the borrower must repay the principal amount. After that, the security ceases to exist. It's extinguished.
A quick clarification on terms. We hear bonds and debentures a lot. Traditionally, bonds were for government or PSU borrowings, and debentures were for corporates, often implying they were secured.
Yes, but the terms are highly interchangeable in common language today. What really matters more is the distinction between secured debt, which gives you rights over specific assets in case of a default, and unsecured debt.
We also need to define the exception to the fixed rate rule, floating rate bonds.
Right. A floating rate bond has an interest rate that is not constant. It's reset periodically, maybe every 6 months, based on a pre-decided benchmark. In India, a major benchmark is MIBOR, the Mumbai Interbank Offer Rates.
So the coupon would be defined as MIBOR plus a certain margin.
Exactly. MIBOR plus a spread. It means the interest you receive adjusts dynamically with short-term market rates.
Lastly, credit rating. Lenders rely very heavily on this.
A credit rating is an independent opinion from an agency like CRISIL or ICARA. It assesses the issuer's capacity to service their debt obligations, both the interest and the principal. A high rating, like AAA, assures lenders of very low default risk, which reduces the coupon rate the issuer has to pay.
Now, the simplest form of a bond is the plain vanilla bond fixed coupon, redeemed at par. But we need to master the variations for the exam.
Let's start with the most extreme variation, the zero coupon bond, ZCB, or a deep discount bond. The defining feature here is that this bond pays no intermediate coupons during its entire life.
So the interest isn't paid in cash, it's earned through the pricing structure. How does that work?
The ZCB is issued at a significant discount to its face value, but it's redeemed at face value. So if a bond has a 100 rupee maturity value, but it's issued at, say, 85 rupees and 80 pays, that 14 rupee 20 pays difference is the effective interest you earn over the bond's life.
And this is ideal for investors who just want to lock in a specific amount of capital appreciation without having to reinvest coupons.
Exactly. Now let's talk about structures that offer flexibility. First, callable bonds.
Okay.
A callable bond includes a call option that benefits the issuer. It allows the issuer to redeem the bonds before the original maturity date, typically after a specified period, like a 10-year bond that's callable after 5 years.
Why would the issuer do this?
Simple. If market interest rates decline significantly, the issuer can call back their expensive high-coupon debt and then reissue fresh debt at the new, lower, cheaper rate. It's great for the issuer.
But it creates call risk for the investor. You lose the chance to stay invested in that high-yielding instrument.
Precisely. Conversely, we have puttable bonds.
This benefits the investor.
It does. These grant the investor the right to seek early redemption or to put the bond back to the issuer. So if market rates rise substantially, you, the investor, can exercise the put option, exit the low-coupon bond you're holding, and quickly reinvest your capital in higher-coupon debt now available in the market. It protects you against rising rates.
And finally, amortizing bonds.
Amortizing bonds change the repayment schedule completely. Instead of the issuer paying the full principal at maturity, the principal is repaid gradually over the life of the bond. Each periodic payment includes both interest and a portion of the principal.
Just like a home loan.
Exactly like a home loan or a car loan. The debt obligation shrinks over time.
Okay, debt instruments are classified by borrower, government, corporate, bank, and by tenor, so money market for under a year or capital market for over a year.
The single most important category you need to know is government securities, GSECs. This includes treasury bonds and dated securities. They're issued by the RBI to fund the central government's fiscal deficit, and their tenors can go from 1 year all the way up to 40 years.
And the most important characteristic is that they are free of credit or default risk. Why is that an absolute certainty in the market?
Because GSECs are backed by the sovereign power of the government. In essence, the government has the ultimate ability to meet its debt obligations through taxation, borrowing, or in an extreme case, by issuing more currency. This means they carry zero credit risk.
And this inherent safety causes GSEC rates to set the absolute benchmark for all other borrowing in the economy?
Which brings us to the credit spread.
Right.
The credit spread is simply the extra premium, the additional yield that a corporate borrower has to pay over the equivalent GSEC rate to compensate you for taking on their credit risk. If the 10-year GSEC yields 7% and a corporate bond yields 10%, that 300 basis point spread is the market's perception of that company's default risk.
And we should also note, GSECs are mandated to be listed, and they are the most liquid segment of the entire Indian debt market.
Oh, by far. They account for over 90% of the trading volume.
Now, let's quickly detail the short-term money market securities. These all have a maturity of less than 1 year.
We have three main ones. First, Treasury bills, T-bills. These are short-term debt issued by the central government, available in 91, 182, and 364-day tenors. And they are zero-coupon instruments issued at a discount, redeemed at par.
Second, corporate short-term paper.
It's commercial papers,
Yeah.
CP. These are unsecured corporate loans issued for up to 364 days. The 90-day tenor is very popular for working capital. Third, you have certificates of deposits, CDs, which are short-term, tradable time deposits issued by banks.
And CPs and CDs typically use that same discount mechanism, like T-bills.
They do.
We also must define the transactions that shape short-term liquidity: repo and reverse repo.
A repo transaction is fundamentally borrowing money against the collateral of securities. You agree to repurchase that security later at a slightly higher price, which implies the interest.
And a reverse repo is just the mirror image.
Lending money and receiving collateral. These are absolutely vital for managing short-term liquidity in the banking system.
And the regulatory innovation here is the tri-party repo.
This is important because it adds a layer of safety and efficiency. A tri-party repo trade is settled through a central counterparty, CCP, like the Clearing Corporation of India, on an electronic platform. The CCP provides a settlement guarantee to both parties. It manages the collateral. It collects margins.
And critically, this platform facilitates repo trades using corporate bonds as collateral.
Which was very difficult to do bilaterally. It's really helped deepen the corporate debt market's liquidity.
One final asset to mention: sovereign gold bonds, SGBs.
Right. SGBs are debt securities issued by the RBI, denominated in grams of gold. They have an 8-year tenor, they pay a fixed semi-annual coupon of 2.5%, and the redemption value is linked to the market price of gold at maturity. They're a much safer alternative to holding physical gold.
No storage risk, no theft risk, and you get some income.
Exactly.
Okay, despite being the safe asset, debt is not risk-free. The NISM exam expects us to understand 5 major risks. Risk 1, inflation or purchasing power risk.
This is the silent killer of fixed income. Since the coupons are fixed contractual payments, debt is acutely vulnerable if inflation starts to outpace the coupon rate. If your bond promises you an 8% coupon, but inflation is running at 10%,
Your real return is negative 2%.
your purchasing power is being eroded. You're losing money in real terms.
Risk 2, default or credit risk.
The risk that the issuer fails to meet the interest or principal payment. As we said, G-SECs are free of this, but all corporate debt carries it. And you must remember that the high coupons offered by lower-rated debt or junk bonds are just compensation for this dramatically increased risk.
Risk 3, reinvestment risk.
This risk comes up when you receive your periodic coupon payments, and then you face the challenge of reinvesting those small amounts at the same or higher rate than your original bond's yield. If interest rates have fallen, you're forced to reinvest that coupon cash at lower rates, meaning your total realized return will be lower than the quoted YTM of the bond.
Risk 4, call risk.
This is the risk in callable bonds, which we just talked about. If interest rates fall, the issuer calls back their high-cost debt early. This forces you to take your principal back and reinvest it at the now prevailing lower market rates, which just disrupts your whole income plan.
And finally, risk 5, liquidity risk.
This is the difficulty or the cost of selling a bond before its maturity. Unlike the highly liquid G-SEC market, the secondary market for corporate bonds can be very, very thin. It's dominated by big institutions. A small investor might struggle to sell their holding quickly to either capture a price gain or to switch into a higher coupon bond.
We have to move beyond pure debt and pure equity now to the instruments that deliberately blend the characteristics of both, the hybrids.
Let's start with convertible debentures. These start their life as a debt instrument, paying regular coupon interest, but to carry a critical feature. The investor has the right, or sometimes the obligation, to convert the debenture into equity shares of the company at a future date, instead of getting their principal back.
And the conversion terms, the date, the ratio, the price, are all fixed when it's issued. What are the types?
We have 3. Fully convertible debentures, FCDs, where the entire face value automatically converts into equity. Partly convertible debentures, PCDs, where only a portion converts and the rest remains debt and is repaid. And optionally convertible debentures, OCDs, where you, the investor, get to decide if you want to convert or just stay a debt holder at maturity.
This structure benefits the issuer because it lets them pay a lower coupon rate than they would on pure debt.
Because the investor is accepting less fixed income in exchange for that potential capital appreciation from the future equity stake.
The main disadvantage for existing shareholders, though, is the dilution of their stake once those debentures convert into new shares.
Correct.
Next up, depository receipts, DRs. These are crucial for companies that want to access foreign capital.
DRs are financial instruments that represent underlying shares of the local company, but they're listed and traded on a stock exchange outside the company's home country, and they're usually denominated in a foreign currency, like US dollars.
We differentiate based on location. If they're listed in the USA, on the NYSE or NASDAQ, they're ADRs, American Depository Receipts.
And if they're listed elsewhere, like London or Luxembourg, they're GDRs, Global Depository Receipts.
And then there's the mirror image, IDRs or Indian Depository Receipts.
Right. These are issued in India, with foreign stocks as the underlying asset, and they are available only to resident Indian investors. A local custodian bank holds the physical shares, which authorizes a foreign depository bank to issue the corresponding receipt.
Explain the concept of two-way fungibility.
Fungibility is just the ability to swap the security back and forth. So two-way fungibility means the underlying shares can be converted into DRs to be traded abroad, and then conversely, the DRs can be converted back into the underlying shares to be traded domestically.
This ensures the prices stay aligned across markets.
It does, though it's subject to very strict regulatory provisions, especially for IDRs.
Moving to another critical debt instrument with an equity option, foreign currency convertible bonds, FCCBs.
FCCBs are debt instruments denominated in a foreign currency, typically US dollars, but they include an option for the holder to convert them into equity shares of the Indian company at a future date. They're governed by the RBI and FEMA.
We need to nail the specific regulatory norms for the exam here.
The most important one is the tenor. The minimum maturity of an SCCB shall be not less than 5 years, and there are strict limits on the regulatory expenses for the issue. A maximum of 4% of the issue size for a public issue and just 2% for a private placement.
These rules are there to control foreign capital flows and minimize issuance costs.
Exactly.
Lastly, warrants.
Warrants are essentially options issued by the company itself, not the exchange. They give the holder the right, but not the obligation, to subscribe to new equity shares at a predetermined price. And they're generally very long-lived, much longer than the typical 9-month maximum for exchange-traded options.
What's the absolutely critical exam detail regarding payment for warrants?
SEBI mandates that you, the investor, must pay 25% of the total consideration upfront when the warrant is issued. The remaining 75% is only paid if and when you choose to exercise the warrant at the predetermined date.
And if you let the warrant expire without exercising it?
You forfeit that initial 25% payment.
Let's discuss the third major asset class, commodities. These are investments in real, physical assets, tangible goods that are consumed or used in manufacturing. Gold, crude oil, agricultural products.
We classify them generally into soft commodities like wheat or coffee, bullion like gold and silver, base metals like copper, and energy like crude oil. Now, investing in the physical form presents huge challenges, mainly storage and insurance costs.
For the retail investor, financial products like commodity ETFs or mutual funds are the way to go. They mitigate those issues.
They do. And unlike analyzing a company, analyzing a commodity requires highly specialized knowledge.
You have to look beyond just macro trends.
Absolutely. You need to track specific fundamental factors for that commodity. Things like global inventory levels, specific weather patterns in key growing regions, or geopolitical risks that might disrupt supply chains.
But commodities play a vital role in a balanced portfolio. Two major ones. First, protection against inflation.
This is their primary defensive attribute. Since commodity prices tend to rise sharply when inflation accelerates, they act as an exceptionally effective hedge against the purchasing power risk that your fixed income debt faces. When the value of cash falls, the price of real assets tends to rise.
And second, their low correlation to equity and debt.
Right. Because they often perform differently during periods of high inflation or crisis, which is exactly when stocks and traditional bonds typically underperform. Adding commodities to your portfolio provides essential diversification benefits. It helps smooth out the overall volatility.
Let's now cover derivatives, which are pure risk transfer instruments derived from the underlying assets we've just discussed.
Okay, so a derivative is a financial instrument whose value is entirely derived from the value of an underlying asset or variable. That could be a stock, an index, a commodity, or an interest rate. They're really mechanisms for efficient risk transfer and price discovery.
The two primary types of exchange-traded derivatives are futures contracts and options contracts.
A futures contract creates a standardized, legally binding obligation for both the buyer and the seller to transact the underlying asset at a preset price on a preset future date.
But an options contract is different.
It is. An options contract grants the holder the right, but not the obligation, to buy or sell the underlying asset.
We have to be clear on the terminology for options. A call option grants the right to buy, and a put option grants the right to sell, both at a pre-specified price called the strike price.
Right. Now let's focus on the exam-critical feature of derivatives. They are underfunded and highly leveraged instruments.
Unpack that for us, because this is where the risk magnification comes from.
It means that to take a position, you don't have to pay the full value of the underlying asset. Instead, a trader only needs to deposit an upfront amount called margin with their broker, which is a small percentage of the contract's total value.
So this small initial margin gives you exposure to the entire value of the underlying asset. That's leverage.
That is leverage. So using the example from the source, if the required margin is 10%, a deposit of just 100 rupees gives you exposure to 1,000 rupees worth of stock. That's 10 times leverage.
And while that can magnify your gains tenfold, it also magnifies your losses tenfold.
Exactly. This characteristic makes derivatives inherently high risk. They are generally only suitable for very sophisticated investors or for entities using them strictly for hedging.
Another key feature is liquidity.
The derivatives markets are often significantly more liquid than the spot or cash markets, just because the margin requirement makes them much easier and cheaper to enter. The trading volumes in indices, for example, often dwarf the volumes in the underlying stocks themselves.
What are the three roles of derivatives in the broader market?
Well, they enable price discovery. helping to set a forward price for the underlying asset. They are excellent risk transfer or hedging tools, allowing risk-averse entities, like an airline hedging its fuel costs, to transfer that risk to willing speculators. And they aid diversification, giving retail investors exposure to specialized classes like currencies and commodities without needing physical delivery.
Let's detail the types traded in India. In equity derivatives, we have contracts on indices like the Nifty and on individual stocks. Let's note the settlement rules.
This is a high-priority exam distinction. Index futures and options are cash-settled on expiry. However, individual stock futures and options are, as mandated by SEBI, settled by physical delivery of the underlying stock.
Which reduces the systemic risk of pure cash-settled speculation.
It does. Now, currency derivatives cover Indian rupee pairs and Krone currency pairs, and all of these are cash-settled in Indian rupees.
Commodity derivatives, gold, metals, etc. are traded, but the options contracts are traded as options on futures contracts.
Not options on the spot commodity itself. That's due to the existing regulatory framework.
And finally, interest rate futures, IRF.
IRFs are available on specified government securities, T-bills, and MIBOR. They're primarily used by banks and financial institutions to hedge against interest rate risk, and they are cash-settled on expiry.
Okay, let's tie all these instrument types back to the individual investor's journey. Every financial goal requires a balance of return, risk, liquidity, and capital preservation. This is the world of asset allocation.
Asset allocation is that strategic process. It's about dividing your total portfolio among different distinct asset classes: equity, debt, gold, real estate, based on your specific time period and your tolerance for risk.
Different goals need different characteristics. For growth and appreciation in value, you need equity shares or equity mutual funds. For regular income, you lean heavily on debt instruments, deposits, or debt funds.
For immediate liquidity and easy access, you want cash and bank deposits, maybe ultra-short-term mutual funds. And for absolute capital preservation, cash and short-term bank deposits are usually favored, even though you have to accept very low returns in exchange for that security.
And the appropriate allocation is dynamic. It changes with your life cycle. Someone nearing retirement needs a much higher debt allocation for income and stability.
Whereas a younger investor with 30 years until retirement can afford to hold a much larger portion in high volatility equity.
This leads right into diversification.
Right. Diversification is defined as combining investments so that a significant drop in the value of one investment is cushioned by stable performance or a rise in others. Now, the key insight here is that the benefit only materializes if the investments you pick do not rise and fall together. They need to have low correlation.
And we practice diversification at two levels. First, across asset classes, equity, debt, gold, and second, within an asset class.
For example, holding equity shares across different uncorrelated sectors, like technology and agriculture, so that a regulatory change affecting just one sector doesn't devastate your entire equity portfolio.
The ultimate success of a portfolio relies on aligning the assets with the investor's needs. Let's run through these factors. Factor 1, managing risk and return.
Asset allocation and diversification are your tactical tools to manage this trade-off effectively. You can't maximize return without accepting the commensurate risk, and vice versa.
Factor 2, aligning investment horizon.
You have to ensure your chosen asset mix matches your time frame. Equity returns are volatile in the short term, but they consistently outperform debt over the long term. Therefore, the longer your horizon, the higher your capacity for volatility, and the greater the justified allocation to equity.
Factor 3, aligning portfolio features to investor needs.
The portfolio's focus has to evolve. If you're saving for retirement, the focus is growth during the accumulation phase. Once you hit retirement, the focus has to shift aggressively toward income generation and capital preservation. That means you need to be systematically rebalancing toward debt.
Factor 4, ease of investments and exits.
Since most saving is periodic, the investment platforms you use must be convenient for regular contributions, like SIPs. But they also have to allow for easy liquidation in case of an emergency or when you need to rebalance. This is why liquidity is so highly prized in the market.
And Factor 5, flexibility and information.
Investments need to offer flexibility. For instance, allowing you to choose a growth option within a mutual fund scheme if you don't need current income, letting the dividends reinvest automatically. And furthermore, regulations mandate that you receive regular information and updates to monitor performance.
This is where we shift from what the instruments are to what they are worth. Valuation is the engine room of active investing.
We have to start by establishing the difference between price and value. Intrinsic value is the theoretical estimate. It's the discounted value of all the future benefits or earnings that an analyst expects that share to generate. The market price is simply the current price at which the share trades, which is determined by the constantly shifting forces of supply and demand.
And the core premise of active investing is that markets are not always rational. They're not perfectly efficient.
Exactly. Equity markets experience temporary inefficiencies. If an analyst estimates the intrinsic value to be significantly more than the market price, the stock is considered undervalued.
And if the intrinsic value is estimated to be less than the market price, the stock is overvalued.
And the entire objective of research and active management is to exploit these inefficiencies by identifying and buying undervalued stock before the market corrects itself.
Let's define the three critical ratios used in fundamental equity analysis. Starting with the king, the price-earnings multiple, PE.
The PE multiple is the valuation currency of the equity market. It tells you how much the market is willing to pay today for 1 rupee of a company's current earning. And it's calculated as market price per share divided by earnings per share, EPS.
So a stock trading at 20 times PE means investors are paying 20 rupees for every 1 rupee of annual earnings.
Correct. And we need to know the general thresholds. A market PE of 22x or above is frequently considered the overvalued zone. It suggests caution. A PE of 12x or lower often lands a stock in the undervalued zone, suggesting potential opportunities.
And analysts will justify a high current PE only if they forecast aggressive future EPS growth.
Yes, growth that brings that forward-looking PE multiple down rapidly.
Next, price to book value, PBV.
PBV compares the market price to the company's accounting value, specifically the book value per share, which is calculated as net worth divided by the shares outstanding. This ratio is mostly useful for asset-heavy sectors like banking or manufacturing.
What's the inherent limitation of using book value?
Well, book value is based on historical cost accounting. It uses the asset cost minus depreciation, and these figures are not inflation adjusted. They can drastically underestimate the asset's current realizable or replacement value.
But despite that, if the PBV ratio is less than 1, it strongly suggests potential undervaluation.
It does, because you're essentially buying the assets for less than their accounting value.
And finally, dividend yield.
This is a cash flow metric. It's calculated as dividend per share divided by market price per share. Now, since the dividend declared is usually fixed for the year, the yield is inversely related to the share price.
So if the price shoots up, the yield falls. This makes it a crucial market cycle indicator, doesn't it?
Absolutely. A raging bull market is always characterized by falling dividend yields because prices are rising much faster than dividends. Conversely, a bear market often sees relatively higher dividend yields as prices decline.
Who does this research and how do they do it? Let's differentiate between buy-side and sell-side research.
Sell-side research is done by broking houses and investment banks. They generate detailed earnings models and reports for external clients. They're essentially selling ideas. Buy-side research is done by institutional investors like mutual funds or insurance companies. Here, analysts are typically generalists, focused on managing portfolio risk and often on killing bad ideas that come from the sell side.
Equity analysis uses two main approaches. First, fundamental analysis.
This is the comprehensive study of financial statements, management quality, the competitive environment, all to estimate the company's future potential and its intrinsic value. It systematically uses the Economy Industry Company, EIC framework.
And we break fundamental analysis into two methodologies, top-down and bottom-up.
The top-down approach starts with a macro view. You analyze the economy. Is GDP growth strong? Then you identify the most favorable sectors, or industry, and then you select the best specific stocks or company within those sectors.
And the bottom-up approach is the reverse.
You start by identifying a great company based on its unique business model. Then you confirm that choice by checking that the industry and macro trends aren't completely prohibitive.
The second main approach is technical analysis.
Technical analysis completely ignores fundamental financial health. It focuses entirely on the study of price and volume patterns charts, moving averages, support and resistance levels to predict the short-term direction of the stock based on perceived market psychology and momentum.
And finally, the actual valuation models analysts use.
We can categorize them into two broad approaches. First, you have discounted cash flow DCF models. These are theoretical, mathematically rigorous, and they involve estimating future cash flows for maybe 20 years, and then discounting them back to the present using a discount rate that acts as a risk proxy.
They're highly sensitive to the analyst's assumptions.
Very. And the second approach is relative valuation models. These are much simpler. They determine fair value by comparing a company's ratios, PE, PVV, to its peer group, its sector averages, or the overall market. The risk, though, is that if the entire sector is overvalued, the relative valuation will just confirm an existing market error.
Now back to debt, where valuation is mathematical, not speculative. The single most important principle is the time value of money, TVM.
TVM is foundational to all of finance. A rupee today is always more valuable than a rupee received in the future.
Because you can invest it immediately and earn a return.
Exactly. Therefore, we have to use a discount rate to convert all future cash flows from a bond, the coupons, and the principal back to the present to determine their present value, PV, which is the bond's theoretical price.
Let's nail the two core concepts that come from TVM in debt valuation.
1. The further out in time a cash flow is, the more heavily it must be discounted, which means the lower its present value. A 30-year bond is intrinsically more volatile than a 5-year bond because more of its value is tied up in cash flows that are very deeply discounted.
2. The higher the discount rate, or the market yield, the lower the present value or price. This relationship defines the entire debt market.
We have to emphasize this until it is second nature for you. There is a constant inverse relationship between the yield and the price of a bond. If market interest rates rise, investors demand a higher yield, which mathematically drives the bond's price down. If market rates fall, the price goes up.
Let's use the bond price calculation steps to illustrate this. Let's say we have a 5-year 100 rupee face value bond with a 10% coupon, and the current market yield is 8%.
Okay, step 1. Calculate all your future cash inflows. That's 5 annual coupons of 10 rupees plus the final principal of 100 rupees. Step 2. Discount each of those inflows back to the present using the current 8% market yield. Step 3. Sum the discounted cash flows.
And when you sum them, the calculated value is 107 rupees and 98 paise. The price is above the face value of 100.
And why? Because the bond's fixed contractual coupon, 10%, is higher than the current prevailing yield the market is offering, which is 8%. Therefore, an investor is willing to pay a premium, that 7 rupees and 98 paise, to get access to that higher cash flow.
Which confirms the inverse rule. When you buy above face value, your actual return or yield will be lower than the coupon rate.
Exactly.
Now, let's define the two primary yield measures. First, current yield.
Current yield is a simple, quick comparison. Coupon rate divided by market price. So if a 12% coupon bond trades at 109 rupees 50 paise, the current yield is 10.95%. It only measures the current annual cash return relative to the price.
But the true measure of return is yield to maturity, YTM. Define that precisely for us.
YTM is the gold standard in the debt market. It is defined as the discount rate, which exactly equates the present value of all future cash flows from a bond, the coupons and the principal, with the current market price of the bond. YTM represents the actual annualized rate of return you will receive if you hold the bond until maturity because it factors in any capital gains or losses from the initial price you paid.
The debt investing process requires a strong focus on macroeconomics and rate forecasting. Security selection depends heavily on the investor. Retail investors prioritize safety and liquidity, so bank deposits, money market MFs.
Right. And institutional investors, with their sophisticated risk management, use GSECs for safety and liquidity, and they use corporate bonds when they need higher returns to meet their liabilities. They're actively managing the credit and duration risk.
Market timing is crucial in debt because of that inverse yield-price relationship. So when should an investor load up on long-dated government securities?
You want to buy long-dated GSECs when you believe the interest rate cycle has peaked. At that moment, yields are high and prices are low. You lock in that high yield and, crucially, you anticipate a significant price rise as the RBI begins to cut rates later in the cycle. That will make the 30-year bond's price soar because of its high duration sensitivity.
Investors also need to monitor the credit outlook, focusing on the credit spread, which is the corporate yield minus the GSEC yield.
The credit spread is an excellent economic barometer. It's typically narrow when the economy is booming because investors feel optimistic and perceive corporate default risk as low.
But the spread widens dramatically during a recession.
It does. Why? Because corporate profitability suffers, which increases perceived risk, and investors demand much higher yields on corporate bonds relative to the risk-free GSEC rate.
The final step is weighting deciding the proportion to allocate to different debt products.
This depends on your interest rate forecast. If you believe rates have peaked and will fall, You should allocate more to gilt funds, which hold long-dated G-Secs, to maximize capital appreciation. Conversely, your allocation to credit risk funds should be kept minimal during recessionary phases when default risk is highest and spreads are widest.
And for the everyday investor who lacks the expertise to forecast RBI rate movements.
The best recommendation is often to invest in dynamic bond funds. These funds automatically manage the portfolio's duration and credit exposure based on the fund manager's active interest rate outlook. It shields the retail investor from having to make those complex macroeconomic calls themselves.
That was an extremely comprehensive deep dive into the investment menu and the underlying valuation principles. Let's quickly recap the absolute exam essentials for you.
Remember the foundation. Equity equals risk, growth, ownership, and that crucial residual claim. Debt equals fixed income, lending, guaranteed principal return, and a fixed maturity. This choice drives your entire portfolio structure.
Second, the necessity of asset allocation based on your time horizon and risk, and the power of diversification using low correlation assets like gold to hedge against inflation and market crashes.
And finally, the valuation math, especially the absolute certainty of the inverse relationship between bond prices and yields. The time value of money dictates this. And you must master the interpretation of the three core equity ratios, PE, PBV, and dividend yield, to judge market pricing.
Now, let's leave you with the final provocative thought, which links our discussion on market timing, TVM, and duration. If you knew definitively that the RBI was planning several rate cuts over the next year, which specific debt instrument, a 91-day Treasury bill, a 90-day commercial paper, or a 30-year dated government security, would likely offer you the highest potential price appreciation, and why?
Think about what the duration does to the price response when yields change. The answer to that question will define your mastery of fixed income valuation. Apply this knowledge diligently, and we look forward to guiding you through the next chapter of the deep dive. Good luck.